Welcome to the Terminology of the Market workshop. Before you can trade with confidence, you need to understand the language. This guide gives you the essential terms every trader must know, from pips and lots to leverage and risk reward. It's not just vocabulary, it's the foundation of clarity, structure, and execution. Master the basics, and the rest of the market starts to make sense. So let's jump right into it. So welcome again to the official Max Edge Society workshop, and welcome to your next step forward, terminology of the market. Before you can read charts, execute strategies, or manage risk with precision, you need to speak the language. Every profession has its own vocabulary, and trading is no different. This workshop is your dictionary, a crystal clear guide to key terms like pips, lots, leverage, risk to reward, and more. No more confusion, no more second guessing, just clarity and confidence. Because this isn't about memorizing jargon. It's about understanding how it all connects. It's about understanding how it all connects to real trades. Every term in this guide ties directly into your risk decisions, your entries, your exits, your strategy. And that's where confidence comes from, comprehension. When you understand the words, the charts begin to speak. The market starts to make sense, and you stop reacting and start responding like a trader. As a beginner, this is your foundation. It gives you the context you need to navigate the market with awareness and control. And when you're ready to take things deeper, the full master guide is waiting for you inside the premium area, packed with strategy, structure, and execution. So let's get started. Welcome to the Max Edge Society, and welcome to the beginning of fluency. What does the market terminology actually mean? Market terminology is the specific language we use in trading and finance. Just like any profession, whether it's medicine, engineering, or law, trading has its own vocabulary. These words and phrases help traders communicate quickly, clearly, and precisely. Especially when analyzing charts, placing trades, or discussing risk and execution. Think of it like learning to drive. You can't operate a car if you don't know what the gas pedal, clutch, or turn signal does. Trading is no different. To take control, you need to know what pips are, what lots mean, how margin works, and what risk to reward really tells you. These terms, they're the control of your trading vehicle. And once you understand them, you don't just follow the market, you start to drive it. Key summary for new traders. Let's break down the core terms every new trader must know, fast and simple. First, the essentials. Pips measure how far price moves. Lots tell you the size of your position, how much you're actually trading. Leverage increases both your potential profit and your potential risk. Margin is the capital you need to open a leveraged position. Stop loss is your safety net. It limits your downside. Take profit locks in gains automatically at a target level. Risk to reward ratio is the math behind profitable systems. And the basics of direction. Long means buy, short means sell. Know why and when you're doing each. Now let's talk chart-based terminology. Reversal, a full change in trend, like uptrend turning into a downtrend, or the other way around. Retracement, temporary pullback. Price breathes before continuing the trend. We call that a retracement. Rejection. Price tests a level but gets slapped back. It can't break through it, so we call it a rejection. Break of structure, or BOS. A swing high or low is broken, trend might be shifting. We call that break of structure. Change of character, an early signal, momentum is starting to shift. Support, a price zone where drops tend to stop and bounce back. Resistance, a zone where price hits a ceiling and often fall back down. Trendline, a line that shows direction connecting highs or lows across time. Engulfing candle, a powerful candle that fully covers the one before it. It's a big signal. Hammer or shooting star. Long wicks show rejection. Reversal may be near. It's a candlestick pattern. Inside bar. A candle stuck inside the previous one. Price is tightening. Flag and pennant. Continuation patterns. Price rests before running again. A so-called liquidity grab. A fake breakout. Price spikes, traps traders, and then reverses. Consolidation. Sideways chop. No clear trend. Just indecision. Break. Strong move out of a range of patterns. Often with momentum. Key level or psychological level. Round numbers where price loves to react. Don't worry, you don't have to recognize or understand all the terminology on this page. While you're reading the other playbooks and watching the other workshops, you will learn it step by step. All the words, all the patterns, everything you need to know. Nothing more, nothing less. So let's talk about one of the most important concepts in Forex trading, pips and pipettes. A pip is how we measure price movement. In most currency pairs, it's the fourth decimal place, 0.0001. So if Euro US dollar moves from 1.1050 to 1.1051, that's one pip. In JPY pairs, the pip is the second decimal, 0.01. A pipette is even smaller. It's the fifth decimal place. That's 1/10 of a pip. Brokers use it for tighter spreads and more precise pricing. Why does this matter? Because pips help you calculate your position size, your stop loss, and your profit target. They're essential for risk management and precision. Bottom line, if you want to control your risk and trade like a pro, you need to understand pips. Next, let's talk about lot sizes in trading. One of the most important concepts for managing your risk, a standard lot is 100,000 units of the base currency. When the market moves 1 pip, you typically gain or lose $10. A mini lot is 10,000 units. Here, 1 pip equals about $1 of movement. Go smaller, a micro lot is just 1,000 units. 1 pip equals $0.10, perfect for learning with lower risk. And the smallest, a nano lot, just 100 units. A single pip here equals 1 cent. This is as safe as it gets when starting out. Bottom line, lot size controls how much you gain or lose per pip. So if you're just beginning, start small. Use microlots to learn the market without risking too much. Let's break down leverage in trading. One of the most powerful tools in the market, but also one of the most dangerous. Leverage lets you control large positions with a small amount of capital. For example, with a 1 to 100 leverage, you can control $100,000 in trades with just $1,000 in your account. Sounds great, right? But remember, leverage is a double-edged sword. Yes, it can multiply your profits, but it also magnifies your losses. Lose control and you could lose more than your initial deposit. That's where risk management matters. If you're new, stick to lower leverage like 1 to 10 or 1 to 20. It gives you more breathing room while you learn how the market moves. Bottom line, leverage is a tool, not a shortcut. Use it wisely. Let's talk about one of the most important tools in your trading arsenal, the stop loss. A stop loss is a predefined price level where your trade automatically closes to limit your loss. Think of it as your trading safety net. It protects your capital when the market moves against you. Why is this essential? Because it removes emotion from your decisions. It stops you from holding on to losing trades too long, and it makes sure your risk is defined, consistent, and manageable. Here's a quick example. You buy Euro US dollar at 1.1000. You place your stop loss at 1.0970. That means your maximum risk is 30 pips, no matter what happens in the market. Even during news events or unexpected volatility, your loss is capped. Without a stop loss, you're gambling. With one, you're managing risk like a professional. Set it, stick to it. That's one of the most important rules inside the academy. It's one of the smartest habits a trader can build. Let's talk about the other side of risk management, locking in your wins. A take profit, or TP, is a predefined price level where your trade automatically closes, securing your profit before the market can turn against you. Think of it like your profit collection point. You're not just hoping for gains, you're planning for them. Why is this so powerful? Because it removes emotion from the decision. It builds structure into your strategy, and it protects you from the trap of holding on too long. Here's a simple example. You buy Euro US dollar at 1.1000. You set your stop loss. You set your take profit at 1.1050. When price hits that level, the trade closes and your profit is locked in. 50 pips secured. No stress, no guesswork. A well-placed TP turns a good idea into a good result. And that's what real trading is all about. Set it, stick to it, and let the market do the rest. Let's break down one of the most basic but powerful ideas in trading: long versus short. So let's talk about one of the most important numbers in trading: risk to reward ratio, or simply RR. It's the comparison between how much you're willing to lose and how much you stand to gain on a trade. For example, if your stop loss is 20 pips and your take profit is 60 pips, that's a 1-to-3 RR. That means one winning trade can cover the losses of 3 losing ones. One winning trade can cover the losses of 3 losing ones. This is the math that makes trading sustainable. Even with a 40% win rate, a positive RR keeps you profitable. So if you want to trade like a professional, stop chasing win rates and start managing your ratios. It's not about being right more often. It's about getting more when you are. Now go calculate your edge. Next is long versus short. Very powerful. A long position means you're betting the market will rise. You buy low and aim to sell higher. For example, buy Euro US dollar at 1.1000 and sell it at 1.1050. That's a 50 pip profit. Now short position is the opposite. You're expecting the market to fall, so you sell high and buy back lower. Sell GBP US dollar at 1.2500, buy at 1.2400. That's 100 pips in the bank. It's important to remember, in Forex, you're always trading pairs. When you go long on one currency, you're shorting another automatically. Mastering both long and short positions gives you flexibility. No matter which way the market moves, you're ready to trade it. Serious traders go premium, not because it sounds good, because they're done playing. If you've made it this far into the terminology workshop, you're not just learning, you're evolving. You're starting to see that trading isn't built on guessing or gut feelings. It's built on clarity, structure, precision. Terminology? It's not a jargon. It's a code, the language of execution. But knowing the words isn't enough. You have to live them and apply them. Bend them to your system and psychology until they become instinct. That's where premium begins. Inside, we strip away the fluff. You get real frameworks, live market breakdowns, feedback tailored to your trades, and full access to the MH method. The system designed to turn knowledge into discipline, and discipline into results. No noise, no crowd. Handpicked, focused, relentless. If you're ready to stop dabbling and start dominating, then you already know what to do. Join Premium and trade like you were meant to be. Thank you for taking the time to dive into this workshop. You can also read the playbook inside your dashboard. These terms aren't just definitions. They're your first steps towards fluency in the market. My name is Max. I built this for traders like you, serious, focused, and ready to do the work. Your journey is just beginning. Your edge is being shaped, one concept at a time. So see you at the charts.